to be able to take out the e-letters I wrote on some of the problems of deflation back in 2002 and update them sometime next year. Again, recessions and the bursting of bubbles are profoundly deflationary. What about housing? Where are we? Because you were right about that.
Oh, it's interesting you asked that question today. I have this paid publication that I do called Conversations with John, where I'll get two of my friends that are experts on something to sit in and talk about a topic. And this morning I sit and talked with Richard Chagra and John Burns of John Burns Realty. Rick's with Realty Track, who are probably the two best experts on housing in America. And I've presented some of their research before and some other research, and it really says that housing prices, we may be bumping along a bottom for a few reasons, and a lot of kind of in a national market. There's various different markets that are still going to have issues. The upper end market hasn't adjusted yet. The lower end have. But we're not going to see a kind of a recovery in the market till 2011, 2012 maybe, to where we start seeing real construction. Now, we'll see a lot of home builders continuing to build. I mean, you'd think that if they were going to hold it, stop digging. But the reality is they can't afford to stop digging. They have to churn cash and churn cash flow in order to make the multiple billions of dollars of loans that they've borrowed, even if they're losing money. I mean, it's sunk cost already, the land, a lot of what they have. So they just got to create that cash flow in order to be able to get themselves through to where we'll be building again. And one day we'll have worked through all the inventory, 2012 maybe. We'll have worked through all of the foreclosures. And by the way, foreclosures are going to continue to rise, not because of subprime issues and faulty mortgage and so forth, but now we're beginning to see economic reasons be the primary reason. We're seeing the prime rate mortgages starting to become a real problem. And then, of course, next year, the option arms kick in, and those are just painful. Typically, an option arm was purchased with 5 years, and people choose what they wanted to pay. So they chose, low percentages, low interest rate, and was negative amortization. Well, if you've been paying using a negative amortization for 5 years, you now owe at least 10% more on your house. Your house has dropped in value 30 or 40%. So you're way upside down. And the option arm reset sets to a 25-year, let's be generous and say it's a 5% mortgage. If they could get one, I mean, where do you find a 25-year, 5-year mortgage? So it's going to set at whatever the pre-agreed upon number was. Well, that doesn't mean your payment just goes up by the interest rate. It now goes up by, you hadn't been making principal. You hadn't even been making full interest. So now your payment could go up two or three times. You just can't do that. And so we could see, if I remember right, about another 1 million homes go through foreclosure for that. It's going to just take some time for it to work through. Now, they were optimistic in saying that a lot of homes are being bought by investors because investors can come in and buy them, fix them up, and rent them out and can make good money at it. But that means they're buying the houses that, 30 and 40 cents on the dollar from peak. He was telling me that there's some areas of California where, in the Riverside area, where there's an investor buying homes for 20 cents on the dollar for what they last sold for. I mean, 20 cents on the dollar is not a lot, but he's paying cash. He doesn't have to worry about getting his loan, and he goes out and he rents it, and he's making a very, very nice return, and he's happy.
Yeah, it was just reported in Miami that they had one of the WCI communities there. As you know, they're bankrupt, so they just liquidated. And the investor bought those, if you want to call them that, because it was a block sale, but 94% off what the market was. 94% off on those condos. And those were new oceanfront condo hotel units in the Luxury One Ball Harbor complex.
Wow.
Yeah, I know.
Now, he can make money on that.
Even for the worst doom and gloom person, he said 94% off.
I mean, an investor with deep pockets and time, there you go. I mean, if nothing else, he just rents it, and he's going to get his money back in 2 years. During the late 80s and early 90s, when we had the savings and loan crisis that hit Texas, there were people, I had a friend who would go in and he would buy apartment complexes for 20 cents, 25 cents on the dollar out of the savings and loan thing, turn them into some type of government-subsidized home or lending, I forget what the program was. He would immediately lease out every apartment, and he got all of his money back in 2 years. I mean, he had put $300,000 into an apartment complex that might have cost, $1.5 million to build, and he had his $300,000 back in his hands in 2 years. And he did that several times. And other people were doing it. Other people were going in, and I remember specifically a friend telling me that he went in and there was a stack of folders, which was loans from various, people from some savings and loan. There were boat loans and car loans and, all sorts of stuff. And a lot of these folders had checks in them. People were sending in their checks, and the check would go in the folder, and it had never been cashed. And he would bid 20 to 25 cents on the dollar for a stack of loans that he generally turned around and doubled his money on, sometimes more. Because, he could go to somebody and say, hey, give me 50 cents on the dollar, and I'll call your loan out, but just do it today. And they'd go, really? Fine, here's your money.
Right.
And, there was nobody there to work the paper. I bought a home in 1991 from the RTC, as it was at the time. At one time, it listed for $810. I bought it for $285. Now, I bid $50,000 less than anybody else, but I put such a big down payment, and I said I'll take it as is, where is, and everybody else wanted them to fix stuff. And the taxpayer would have been better off taking somebody else's bid and, hiring somebody to go do the little fix-it stuff. But the guy sitting behind the desk said, I've got 20 houses to move through today, every day. Click, it's yours. And that's the way these things go.
I'm going to move it to 2007. We'll get away from real estate here for just a minute. But this was very interesting. September 14th. There are also profound, this is what you wrote at that time, there are also profound and rapid changes happening in the world of finance. Only a few decades ago, there was only a relatively small amount of derivatives in the world as compared to the totality of human commerce. Today, we have a reported $450 trillion in derivatives. For us to think that such a thing can come about and not add to the unpredictable nature of the world is not realistic, end quote. You also took that week to highlight Nassim Taleb's book, The Black Swan. This is what you chose to highlight from the book. In other words, it creates devastating black swans. We have never lived before under the threat of a global collapse. Financial institutions have been merging into smaller number of very large banks. Almost all banks are now interrelated. So the financial ecology is swelling into gigantic, incestuous, bureaucratic banks. When one falls, they all fall. True, we now have fewer failures, but when they occur, I shiver at the thought. I rephrase here, we will have fewer but more severe crises, end quote. The timing of your discussion of the dangers of derivatives and mentioning Nassim's book was right in front of the financial storm and just weeks before the stock market topped and began its precipitous fall. What made you warn about derivatives at that time and sound an alarm bell for a coming crisis, John? Because the timing was right for such a warning.
Well, I've been writing about the problem with derivatives probably since 2005. Early on, I thought they were not a problem. And I've actually written that we need more derivatives and not less. That's true, we do. But I've been pounding the table for years that we need to put the derivatives and move them to an exchange. That was the problem, is that there were people writing derivatives that they didn't have themselves adequately capitalized. And we didn't know where they were. And sure enough, there were people writing naked derivatives, if you will, called AIG and other groups. And I knew there were hedge funds doing it because you could look at hedge funds, and there were certain hedge funds that were saying that they were playing in the credit markets, blah, blah, blah. But you would see very, very steady streams of return. And if you're playing in the credit markets, you shouldn't be seeing steady streams of return. If you do, what you've got is somebody selling naked call options. It almost invariably, or it's a fraud like Madoff. But I mean, steady returns have to really, raise your antenna. And so it was clear there were hedge funds out there selling naked call options. As it turns out, the biggest hedge fund in the world was AIG. And most of the people at AIG didn't even realize what was going on. I'm sure they had no idea of the nature of their exposure. Only a few did. And they had mathematicians and physicists create models that said, look, this is the risk we're taking. We're fine. And we now know that was wrong. So, but I've been pounding the table for a long time to get derivatives on an exchange of somewhere, and I think that's going to end up that way. And I mean, there's going to be a lot of banks that don't like that, but I don't care. It just puts the system too much at risk. And somebody who writes a derivative, who sells an option, needs to put up adequate capital to make sure that there's somebody on the other side that makes sure that the system isn't at risk.
Thank you for joining us at KingWorldNews.com. Remember to go to our homepage for more interviews, and be sure to tune in next week for another great show where we will have part 2 of John Mauldin's interview, plus more outstanding guests. For more KWN exclusive interviews, you can go to our business page and our Gold Plus page.